welcome back. You're still watching the special SAMPC broadcast here on CNBC Africa with myself, Nastasia Arendse. Joining me for more analysis, we have Carmen, who's the head of multi-asset strategy at Terebinth Capital. Next to her is Botha, who's the head of fixed income at Ashburton Investments. And of course, we have Isaah Mhlanga, who's the chief economist and head of research at RMB. Isaah, let me start off with you. Was this decision in line with your expectations?
Indeed, it was in line with our expectations. We were just surprised with an alternative scenario for a 3% inflation target. But as far as the decision itself, the inflation forecast, we are not surprised.
Let's stay with that, Isaah. Why were you surprised at that alternative scenario?
Look, the introduction of an alternative scenario would presuppose that they are now actively considering targeting a lower inflation target. But this is not an official announcement in our view, because that has to come from National Treasury, as the custodian of the framework. But the way it happened in 2017 is exactly how it's happening now, an announcement of a preference for a lower target. So that would mean that markets will adjust to that lower target over time.
Carmen, let me come to you. As you look at that statement from the MPC and you listen to those comments coming out of Lesetja Kganyago, what has changed for this committee right now versus where we were in March?
In March, it certainly, in my mind, was a missed opportunity not to have cut then. And I think the only thing really that has changed is probably that inflation continued to surprise to the downside. And then also the acknowledgement that the growth outlook has weakened. So the combination of those two factors effectively forced the MPC to sort of catch up with the data to deliver a cut. I would say the cut was less of a surprise, but I think the high conviction on the MPC, so all of the MPC members voted for a cut, and one actually voted for a 50 basis point cut. So we go from some on hold last time to everyone on agreeing to a cut now. That is a big surprise, but I suppose I would caution that one shouldn't read it as too dovish, given that this is probably a catch-up move rather than a really forward-looking one.
Albert, let's bring you in the conversation. Your thoughts as you reflect on that MPC statement.
So I agree with the previous panels. The cut, I think, was largely expected. We were one cut behind the Fed already in their rate cutting cycle. They've cut 1% from their peak. We were only 75 basis points thus far. Also, one of the big things that we looked at was to what degree would the Reserve Bank be willing to cut, given that the Fed has effectively been on hold for so long. There were a number of market commentators that said the fact that the Fed isn't cutting is going to stall or potentially cause potential issues with the Reserve Bank. I'm happy to see that was not the case. Seeing this independent action and also seeing the governor starting to massage expectations on inflation down to 3%, I think both are going to be very good for the local SA bond market and for the local consumers.
Albert, let me stay with you, because oftentimes when we look at the US bond market, we often talk about what signals or cues we're picking up from the US bond market. When you look at the bond market in general, and let's bring in the US and perhaps even the South African side, what cues and signals are you taking from the way we've performed?
We've narrowed quite meaningfully to the US bond market over the last couple of months from where we were trading last year. Some of that is due to a reduction in the risk premium of South Africa versus US bonds, but some of that's also due to the US government bond, quite frankly, becoming riskier, right? If you look at the risk premium embedded in the US 10-year, that's been rising slowly but surely over the last year or so. It continues a long-term trend that follows from the US having massively high debt to GDP ratios considered historically, as well as fiscal deficits that are some of the highest that they've seen outside of kind of wartime or recessions. So the US bond market is becoming riskier at exactly a time when South Africa's bonds are seeing a little bit of a reduction in yield. That combined with the fact that we now have kind of real yields globally means that investors, and specifically fixed income investors, in South Africa and everywhere, can get higher returns when they invest in your fixed income asset class. It's something a lot of investors weren't used to for much of the 2010s and early 2020s.
Isaah, I want to come to you for this one because the last time you and I had a conversation, we took into consideration just the back and forth and just how quickly things are moving, coming out of, Washington, and how it was quite difficult to put out an outlook, but it was far more, I suppose, call it amenable to work with scenarios that you can alter and add in information as it comes. The one thing that has stood out to me is that when they look at their GDP projections for South Africa, they currently expect growth of 1.2% this year, rising to 1.8 by 2027. You look at other institutions, they've also had to revise down their growth expectations for South Africa. Where are your growth expectations sitting right now if you're still doing scenario analysis?
Look, we have 1.3% for this year, 1.6% next year, and 1.8% the year after. So more in line with what the Reserve Bank has now tabled. And of course, we have to understand that in the March MPC, there was a lot of uncertainty. We had the budget process that had been, rejected, still being revised. You didn't know how that was going to pan out, but we also had the Liberation Day, tariffs that were announced by the Trump administration that have been suspended for 90 days. So you didn't know, how that was going to pan out again. Now, the budget process is complete, fairly okay, nothing surprising without the VAT. But we're also getting, a rescinding of the tariffs that are coming out of the U.S. administration that suggest that we will end up with much lower tariffs than those that were initially announced, which then suppose that the risks that the SARB saw in March have all subsided. But even if we didn't have a 90-day suspension, even if we didn't have some rescinding on China, the tariffs themselves were never sustainable to start with because they would tip the U.S. economy into a recession. They had to come down at some point in time. It was just a matter of timing on when we're supposed to see those tariffs and the risks subside. So it made sense for the SARB to wait in March. But having seen this risk subside, it was almost difficult for the SARB to sit tight and not make a move, despite the fact that we still have some level of uncertainty. And all these things, they filtered through into lower growth expectations. We do have domestic issues as well. If you look at the drivers of growth that we expected for this year, fixed investment was one of them. And we've been surprised at the slow pace of a pickup in fixed investment, which is also one of the reasons why we had lowered our growth expectations to 1.3%. But by all means, the SARB is now more in line with market expectations, more in line with our own expectations on growth.
Carmen, let me come to you. I mean, picking up on where the SARB is when it comes to their expectations on growth, but also taking into consideration the theme of uncertainty, which Governor Lesetja Kganyago emphasized. What has changed from an asset strategy point of view, especially when you take into consideration this volatile couple of months?
Well, I think actually nothing's changed in the sense that you need to stay diversified. I think there should also be arguably an increased sensitivity to price levels, so you don't want to overpay for a potentially volatile asset. The point being made that certainly fixed income across the world is now more attractive, but even there, you've got sort of DM risk premium rising, as Albert mentioned, which could make EM more attractive. So I think the challenge in terms of investing and asset allocation is that we are undergoing a regime shift. It's not going to be overnight, so you're going to have frictions. So if US yields, for example, continue to rise, does that automatically mean emerging market yields should be higher? Or can they sort of stomach a higher US risk premium because potentially things are looking better domestically? So I think, diversification is key. Being patient and then sort of looking at what the market's pricing and to ask whether that's reasonable. So we had, for example, the market pricing in around 4 cuts for the US this year at the height of the tariff fears. That's dissipated quite sharply, now moving to only about almost 2 rate cuts. Maybe that's more reasonable. If the uncertainty persists, there's a strong argument to be made that US growth will continue to slow, and therefore the Fed should continue to ease. But it remains quite tricky, and you sort of have to then use your scenario analysis to say what's plausible in terms of market pricing. I think locally, the market may start to look for further interest rate cuts, certainly interpreting the high conviction call with all of the members voting for a cut, which could give a further boost to bonds and a further boost to domestic equities. But I would caution against that, just because we are then in June, July, running into quite a bit of event risk around the end of the pause periods. We've got the debt ceiling debate coming through in the US. The budget in the US is a potential risk factor. So it's tricky. Uncertainty is here to stay, and therefore you have to be more sensitive to what the market's pricing.
Carmen, what's the conversation with you and the team when you try and define what diversification means in this environment, especially when we're kind of unclear about the current relationship we're seeing between bonds and stocks?
Yes, so that is a very valid point, in the sense that you shouldn't just rely on the historical correlations and relationships that would have held. I think another great example, despite the bond equity one in the US, would, for example, be the rand. So usually when there's a meaningful risk off or a global growth scare, that the rand actually weakens, and that then is as a sort of implicit hedge in SA-based portfolios, whereas this time round, you didn't really see that. So the governor highlighted we had this temporary weakness in the rand, but the rand versus the dollar recovered very quickly, whereas obviously on a broader trade-weighted basis, it's only back to it was before the Liberation Day tariffs. So I think what one should do is be careful to rely on long-run historical relationships. Obviously, they have not necessarily entirely broken down, and we actually, because we're in this regime shift, we don't know what these new correlations and relationships will be, but then you have to sort of tease them out and also factor them in to your portfolio construction based on your various scenarios that you're trying to gauge relative to market pricing. So I think those are valid examples and part of the challenge in terms of you can't just do old school diversification given the very uncertain global and geopolitical backdrop.
Albert, I want to bring you into this conversation because prior to Governor Lesetja Kganyago getting to the podium, we did get data out of the US, and a bit of a mixed bag here when you look at what's going on with headline GDP, personal consumption, and a lot of the consensus view, at least when I look at my screen, is that based on this data that's coming in, there's no big catalyst here for the Fed to change their wait-and-see approach. If you look at market pricing right now, or at least market expectations for rate cuts, where's your first rate cut expectation? Are you expecting it in June or July for the Fed?
So the Fed has been in a wait-and-see mood now for months, right? One of the problems with the way they've approached the recent rate cutting cycle is that they've been extremely data dependent. And that has led to massive volatility in the outlooks on when are you going to cut and the number of cuts. Carmen mentioned a little bit earlier that they had 4 cuts priced in, and now they have 2. At some point last year, they had 8 cuts priced in, and then they had 0, and then they had 4 cuts again. So there was massive uncertainty and volatility around how the Fed is interpreting this data. I think broadly, the Fed is going to be very, very nervous to front run any of these cuts. They still have inflation peaking in the US and from here on up to roughly between 3.5 and 3.9 towards October. They're currently sitting on 2%. I think that any kind of cut in the Fed is probably more likely to be in July. But there is certainly a tail risk that the Fed sees out the rest of the year and only starts looking for cuts once it's seen inflation coming back from a peak that it's going to be seeing in the kind of the third quarter, start of the fourth quarter. So that's the outside risk to take into account, that the Fed might not do cuts in July and June and effectively wait for the fourth quarter to see inflation start dropping again before they effectively do cuts. The outside risk to that is if there's a meaningful market event or recession, which forces them into a cutting cycle to help stimulate the economy.
Isaah, I want to bring you into this conversation as you think about, I call it the Fed's dilemma, because if they've been so data dependent and they're quite nervous to make moves, one would start thinking that perhaps the Fed is going to be late. As you think about, some of the things they have to deal with and the data coming in, soft versus hard data, do you find yourself wondering what late means for that FOMC sitting in the United States?
That's correct. I think it's going to be the balance between, inflation considerations as well as economic growth. We had the Fed saying it's a 50% probability of a U.S. recession last night, and that is a huge probability for a U.S. to go into a recession. And if that were to materialize, then we'll see the balance tilt towards growth consideration a lot more compared to inflation considerations. In that environment, they may well cut earlier, which would imply June, which relative to later, because the growth issues will be at the forefront relative to inflation issues. But I think if we look at the tariff developments, it suggests that it's less tariffs relative to initial announcement, which would suggest that the growth knock of these tariffs is likely to be lower than initially expected, and perhaps we will see the recession probability reducing, which will then suggest a delay in cut rather than an earlier cut.
Carmen, let me bring you into the conversation. If we do see that recession probability reducing, does it give one the reason to be able to look back in the US? And also, I suppose, as a second part to my question, how are you defining the Sell America trade to clients who may be asking about that?
Yes, I think certainly I agree with Isaah that given the information we have, the risk of recession has declined. Although I would caution that although some of the underlying data in the US still looks quite robust, there is a risk that there's a lot of front loading in terms of demand because of all these tariffs or pending tariffs and pauses, that you front load in first half growth, and therefore you've got a bit of payback to come through in the second half. So you have a bit more pronounced weakness, although it's at the same time you can argue a weaker dollar plus a low oil price would actually be positive for growth down the line. So there are sort of mixed factors that could either support or weigh on US growth. I would be careful just to say sort of a blanket Sell America. I do agree that, as Albert mentioned earlier, the risk premium in US bonds, it is rising. The risk premium in the US dollar is increasing. And at the time, you expect the risk premium in US equities to also reveal itself. Although, US equities do earn quite a bit of their earnings or profits from outside of the US. So I wouldn't just, throw the US out with the bathwater. I think there certainly still is a case for US assets within a portfolio. But it does depend on your time horizon. On a longer term projection, it seems we're in a structurally rising yield environment unless the federal government is going to do something about the deficits. And so far, there is no evidence that they're willing to rein in the deficit. So I think it is to be a bit more tactical. And if risk premium is adequate, so almost like you need to start looking at the US the way you would look at any emerging market, is to say if the risk premium is high and adequate, then you'd be willing to invest, because you'll be compensated for the volatility. And if you think it's inadequate, so maybe you can still argue the dollar is not yet giving enough risk premium, it still seems somewhat overvalued, then you shouldn't be investing in the US. But I don't think it should be an all or nothing approach. But again, so it sort of brings back the theme of diversification and it actually now being awarded versus historically over the last 15 years, you just have to put all your money in the S&P and you would be fine.
Carmen, I want to stay with you and go back to the MPC statement by Governor Lesetja Kganyago, where he talks about having considered a scenario with a 3% inflation objective. Has the SARB introduced that 3% target? What are you hearing?
Well, I mean, they clearly have introduced it today. It might not be condoned or officially adopted by the National Treasury, and as I highlighted that, so it's a similar tactic to 2017 when they moved from a 3 to 6% target to 4.5%, but I think they are laying their cards on the table. And given that they will be publishing the 3% scenario going forward, we need to take it seriously. And I think that is what partly shapes my view that although it wasn't a hawkish statement, there is a reasonable probability that this was the last cut in the cycle. And I think what we need to look at really is what the inflation rate is going to do. So if it is going to rise towards 4.5% over the next 12 months, then it's going to be difficult for the Reserve Bank to cut because they want to anchor it at 3%. If it stays around 3%, then you've got very high real rates, and that will give some scope to cut rates. So I think shorter term, it's long-term gain of lower sustained interest rates, but the short-term pain is that they may have to stay higher in the near term, even though the economy actually does need monetary policy support. And it's sort of part of the design would be to keep domestic demand weak to ensure that you keep inflation around 3% until inflation expectations follow suit. So I do think we need to take note of it, particularly that they are going to carry on publishing the scenario at the next MPC meetings.
Albert, taking into consideration everything we've discussed, including Carmen's comments just now, along the curve, where are you most comfortable?
So when you look at the South African bond market, you have bonds ranging from those maturing in 2027 all the way out to bonds maturing in 2050 or later on. And obviously for everyone listening to this call, the longer you're out in the bond curve, the higher your yield starts becoming. We tend to prefer bonds somewhere between those maturing in 2035 and 2040, what is broadly considered, let's say, the belly of the curve. You're getting decently high returns and initial yields in that space, but you're also benefiting from the bonds not having too long a term to maturity, and they roll down the curve a little bit, like a ball rolling down a hill. Effectively, their yields become lower as they become closer to maturity. They are slightly less volatile. So that's where we think the best kind of bang for your buck is. We've been looking to buy some of the bonds and have bought some bonds in that space. And then for clients on that's a little bit more worried about inflation, your 2033 inflation-linked bond is yielding 5.1% in real terms. For anyone that wants an inflation-guaranteed return over a 5-year plus horizon, getting a 5% guaranteed kind of sleep well at night return in that kind of space is not a bad return either, especially if there's any kind of outside inflation surprise, which with President Trump in the White House is not something you can ever rule out entirely.
Isaah, as we wrap up the conversation and borrowing from Albert there in terms of sleeping well at night, what's your strategic anchor as you navigate the next 12 months with a White House that is quite unpredictable?
It's quite difficult. I think we just have to embrace volatility. But having said that, there are scenarios that are plausible, and we have to continue to sketch these scenarios and go with the most plausible scenarios, while keeping the alternatives in the back of the envelope to make sure that if things shift, you can also adjust your views, appropriately. But as it stands, we're likely to see a retracement of the tariffs, at least not to the same extent as they were announced on Liberation Day. They're likely to be pared back quite significantly. So we are watching quite closely the U.S. court judgment that suspended, or at least that ruled that the tariffs were not implemented in the right legal framework. There is going to be an appeal, which, if it succeeds, again, it will bring back those tariffs. So quite a bit of volatility that we should expect, and a lot of event risk, to Carmen's point earlier on, as we move into June and July. So volatility is the name of the game, but we need to remain vigilant in terms of where are the scenarios moving towards.
On that note, that's where we leave it for today. Thank you so much to my guests. You heard there the voice of Isaah Mhlanga, who is the Chief Economist and Head of Research at RMB. And he was joined, of course, by Albert Botha, the Head of Fixed Income at Ashburton Investments. And next to him on your screen there is Carmen, who's the Head of Multi-Asset Strategy at Terebinth Capital. That's where we leave it. Thank you so much for tuning in. In the next 30 minutes, we'll have Closing Bell Southern Africa, so you want to stay tuned for that. It's a goodbye for now.